A balance sheet is one of the most crucial financial documents a business can have. It provides a snapshot of a company's financial position at any given moment, displaying the assets, liabilities, and shareholder equity. For investors, business owners, or anyone looking to understand a company's financial health, reading a balance sheet is essential. However, it can be a daunting task for beginners due to its technical nature and numerous components. In this video, we'll break down the top 10 ways you can read a balance sheet like a pro, so you can quickly gain insights into a company's financial standing. 1. Understand the basic structure of a balance sheet. A balance sheet consists of three primary sections: assets, liabilities, and equity. Assets are everything the company owns, liabilities are what it owes, and equity represents the ownership value after liabilities are subtracted from assets. The basic accounting equation that forms the foundation of any balance sheet is assets equals liabilities plus equity. Assets equals liabilities plus equity. Solution. Familiarize yourself with this structure to better understand how the financial data is organized. Assets should always equal the sum of liabilities and equity. 2. Distinguish between current and non-current assets. Assets on the balance sheet are divided into current and non-current, also known as long-term, categories. Current assets include cash, accounts receivable, and inventory, items expected to be converted into cash within a year. Non-current assets include property, plant, equipment, and intangible assets like patents and goodwill. Solution. Focus on current assets for short-term liquidity, and non-current assets for a longer-term investment perspective. This distinction helps assess how easily a company can meet its short-term obligations. 3. Assess the company's liquidity through current assets. Liquidity refers to how easily a company can convert assets into cash to meet short-term obligations. Current assets are a direct indicator of this, and the current ratio, current assets divided by current liabilities, is often used to measure liquidity. Solution. A current ratio of 1 or higher suggests that the company has enough current assets to cover its current liabilities. A ratio below 1 could indicate potential liquidity issues. 4. Evaluate long-term debt and liabilities. Liabilities are amounts that the company owes to external parties, and they are also divided into current, due within a year, and non-current, due after a year. Long-term debt, which is part of non-current liabilities, can give insights into how much a company is relying on borrowed capital. Solution. Pay attention to the ratio of long-term debt to equity, known as the debt-to-equity ratio. A high debt-to-equity ratio may indicate higher financial risk, while a lower ratio generally suggests a more conservative approach to debt. 5. Focus on shareholders' equity. Shareholders' equity represents the ownership value in the company, which is calculated as total assets minus total liabilities. It reflects the company's net worth and is an important measure of financial health. Positive equity indicates that the company is solvent, while negative equity signals financial distress. Solution. Look for steady growth in equity over time, which indicates that the company is accumulating value and generating profits. If equity is declining, it may suggest issues with profitability or over-reliance on debt. 6. Look for significant changes in retained earnings. Retained earnings, a component of equity, represent the cumulative amount of net income the company has reinvested into its operations, rather than paying out as dividends. A large increase in retained earnings usually signals profitability, while a decrease may indicate losses or dividends paid out. Solution. Examine retained earnings to understand the company's historical profitability and how much of its profits are reinvested for future growth. Large fluctuations might require further investigation. 7. Analyze the working capital. Working capital is a measure of a company's short-term financial health and operational efficiency. It is calculated by subtracting current liabilities from current assets. Positive working capital means the company can cover its short-term debts, while negative working capital indicates potential liquidity problems. Solution. Keep an eye on the working capital trend to assess how efficiently the company manages its day-to-day operations. Significant changes in working capital might point to changes in business strategy or operational challenges. 8. Pay attention to off-balance sheet items. Off-balance sheet items include financial obligations or assets that are not directly recorded on the balance sheet. These can include operating leases, joint ventures, or contingencies. While they do not appear in the primary sections of the balance sheet, they can still impact the company's financial position. Solution: review the notes to the financial statements to check for off-balance sheet items. These items might be disclosed in the footnotes, and while they don't appear directly on the balance sheet, they can affect the company's financial risks and obligations. 9. Evaluate the impact of intangible assets. Intangible assets such as patents, trademarks, and goodwill are not physical in nature but can have significant value. However, intangible assets are often harder to evaluate and can be subject to impairment if their value declines over time. Solution: be cautious when interpreting the value of intangible assets, as they can fluctuate based on market conditions or company performance. Pay attention to any impairments of intangible assets, as they may indicate a decline in the company's brand value or competitive position. 10. Look at trends over time. A single balance sheet can provide valuable information, but analyzing multiple balance sheets over time gives a more comprehensive view of a company's financial health. Look for trends in key metrics such as total assets, liabilities, equity, and cash flow. Solution: comparing balance sheets from different periods helps identify whether the company is growing, reducing debt, increasing equity, or improving its liquidity. Long-term trends can reveal a company's stability and profitability. Reading a balance sheet doesn't have to be a complicated task. By understanding the key components and how they relate to each other, you can gain a deeper understanding of a company's financial health and make more informed business or investment decisions. Whether you're an investor, a business owner, or simply someone looking to improve their financial literacy, these 10 strategies will help you read a balance sheet like a pro and uncover insights that go beyond the numbers.